Good to see you. Thank you for making the trip.
It is a pleasure to be here. Let me say off the start, what an honor it is to be back in Riyadh. I was literally in this building, this magnificent building, 2 years ago for what was the last G20 in-person meeting for 18 months, hosted by Mohammed Al-Jadaan, the Minister of Finance. So it's good to be back on the road, and it's good to be back in the same place.
Yeah, and what a crowd.
Yes, absolutely.
Let's talk macro. Since you've left the Bank of England has raised rates. Now the Fed is expected to raise rates quite soon. How should we be thinking about the global economy right now?
Well, I think a couple things. I just referenced that I had my last G20 meeting here,
Yeah.
and you referenced that I was a governor for 14 years. And I have to say that for virtually that entire period in the global economy, the major issue for central banks, the major issue for the economy was deficient demand. Basically, in most economies, inflation was below target. We weren't at full employment. We weren't at full capacity of the economy. And central banks were trying to provide enough stimulus to move both of those key outcomes, inflation back to a reasonable level and employment back to where it should be. And things have moved since then. Now the supply side of the economy is much more important. We've had short-term supply shocks, obviously, because of the pandemic. We all know about supply chain issues and others. But we're having major investments and prospect of much more to come, very much exemplified by Vision 2030 here in Saudi Arabia. The climate transition as another example, digitization as a third example, all of which are impacting the supply side. Some volatility around that, and it means that central banks are in a position not where both sides of the equation are saying stimulate, but you have inflation above target, you still have some spare capacity in economies, and they're having to make trade-offs. So it's a fairly different macro environment than the one I left.
And you mentioned inflation above target.
Yeah.
We got inflation numbers just yesterday in the United States, 7%, the highest in, 4 decades. How concerned should we be about inflation and the prospect of hyperinflation?
Well, not the latter, not concerned about that, but it's not just the headline inflation being high, and it absolutely is, but the core measures of inflation and the breadth of inflationary pressures are significant in the United States. The Fed's acknowledged that and sent some fairly clear signals of rate increases and the start of potentially balance sheet reduction, so a tightening of monetary policy. And really the question is, how long does that go on? What's necessary to get inflation fully back to a low, stable, and predictable level? And my judgment is that it's going to take some time. It's going to take a fair number of moves in order to reestablish price stability in the United States and in other economies.
But it will.
Well, it can be done. But I should say, and maybe I should have said at the outset, but this is in the context of a global economy that's going to grow above trend this year, probably going to grow a little above trend in my judgment next year as well, where economies are going to be pretty close to full employment, and where we're potentially on the cusp of an investment boom in a variety of sectors, including the minerals and mining sector, but some pretty strong tailwinds coming to global growth.
Last macro question. We're going to have a closing debate in several hours here. We're talking about what the world's going to look like in 2032. What's the global economy going to look like?
Well, I have enough confidence in my fellow central bankers that inflation will be at 2% on target. I think I think the world economy by 2032 is going to be fairly different in the sense of we're going to be on the road to sustainability, so substantial investment will have been made in that. I think the trading system will have settled into a position where there is a differentiation by activity, whether there's free flow of goods and services, so more frictions around tech, some frictions around carbon, if you will, but then more broadly an open trading system. So look, I'm pretty upbeat about the prospects in the medium term, but of course execution is everything in order to get there.
Take us back to COP26, putting on your climate action hat and your role as the UN Special Envoy for climate action. What do we need to know about what took place in Glasgow?
I think there's a couple things that are very significant, for this event and those attending. The first is that the world came together both at COP26 and the week before at the Italian G20 and confirmed, in fact, tightened the objective to 1.5 degrees. So Paris was less than 2. COP26 is 1.5 degrees with no overshoot. That's the first point. The second is that there's huge movement in terms of commitments of countries to net zero and that goal. So 2 years ago, less than a third of global emissions were covered by net zero commitments of countries. Coming out of Glasgow, 90% of emissions are covered by that, and Saudi Arabia obviously part of at the forefront with its 2060 commitment. So the next 2 points, and I'll leave it at these other 2 points, which is that these commitments are now cascading down to the private sector. So we have over 5,000 of the world's largest companies who've committed to net zero and are looking to put in place the investments in order to move in that direction, directly relevant for this sector. We have the financial sector moving for those commitments. 40% of global financial assets committing to net zero. And that's not some 2050 distant objective, it is that, but it's 50% down on their financed emissions. So if they're a bank, the people they lend to, if they're an investment house, those they invest in, to get capital to projects that are reducing those emissions. Obviously, mining plays a key role in all of that. So there is a huge shift in which both an intention towards achieving net zero and the role that it plays in creating value. That's all to the positive. Now, as I said a moment ago about global macro, execution is everything. We've got the commitments and the intentions, and going forward, the issue is to translate those into the actions that will make the difference.
And you mentioned the banks. I cannot not mention that against the odds, you managed to sign up all major Western banks to your Glasgow Financial Alliance to net zero and get them to agree to direct $130 trillion of private capital towards decarbonization. That's a lot of money. So two questions. What is like, what guns did you have in the room? You were pointing at them. And 130 trillion, that explain like...
Well, let me explain the number first.
Yeah.
So some people...
Just what it means.
Yeah, some people... Well, first off, it's the assets that those banks, the world's largest asset managers, biggest pension funds, et cetera, control. So that's, who they lend to, who they invest in. And the commitment is that over time, those recipients of those loans and those investments themselves are going to have reduced their emissions. Now, why did they do that? Why did they agree to sign up? And look, and Ryan, full disclosure, it's a bit of a coordination game. The more people you get in, the more people you're going to get in, because people see where the world's going. And the conviction became established that, look, this is where the world wants to go. After all, we've got 90% of emissions covered by country net zero objectives. It's a risk if I do nothing about that. But on the other hand, it's a massive opportunity if I find the businesses that have projects to get their emissions down, find the companies that have new solutions to get emissions down, and put money to work in service of that goal. So you're shifting from values, sustainability, to value in the market. So I would say that the level of enthusiasm amongst those banks, those asset managers, and others for solutions is very high. And again, as I think you've heard over the last couple days here, this very much can be part of the solution.
You talked about the change in the climate and the change in action and goals from Italy and Glasgow, for going from capping global warming at 2 degrees above, at 1.5 degrees above, from a previous target of 2 degrees above. So getting more aggressive in trying to cap global warming. I'm just interested, how big of a change is that? How much more ambitious is capping at 1.5 degrees versus 2? Is it as simple as, well, it's just 30% more ambitious, or?
No, it's, well, the two things, is a great question. There's two things about it. One is, why did they do that?
Yeah.
Because, let's face it, since Paris, where that original objective was established, a lot of good intentions, but not that much action.
Yeah. That was, remind me, going back.
That was 6 years ago.
Right.
Paris was 6 years ago. And so, but why did they tighten it? Well, they tightened it because, unfortunately, the scientific evidence and the lived experience in terms of extreme weather events is it's that much worse than we had previously thought to go from 1.5 to 2 degrees. It's nonlinear in terms of the impacts, the climate impacts. So the importance of achieving 1.5 degrees has gone up. In terms of degree of difficulty,
yeah.
It means we need to start acting now. I mean, that's the essence of it. And as I referenced earlier, it means in effect we need to reduce emissions by about 45% over the course of the next 10 years on a global basis. You know, the good news in that respect is that the technologies exist today. They're being put to work today. That's part of what I do. And you know, my day job at Brookfield is you know, huge investments in wind and solar, battery storage around the world. It's, you know, very commercial. It's a question of finding the, you know, the opportunities, the siting, and putting them to work. That's the good news in terms of the technologies and over the course of the next decade or so. The challenge, of course, it's just a lot of investment that's necessary. And if I can just link it back to the macro discussion at the start, the orders of magnitude of additional investment for energy alone is about 2 percentage points of global GDP. So an additional 2 percentage points of global GDP. That's
energy alone.
Energy alone. So that would, which is the biggest component, but that doesn't include, for example, the mining sector in support of that. It doesn't include in the steel sector for, you know, new processes and approaches. It doesn't include spending on resilience because there's more extreme weather events, and you have to you know, spend and address that. But that additional 2 percentage points of GDP, this is my macro point, that's the order of magnitude of the decline in investment that's happened over the course of the last 20 years. So part of the so-called savings glut, Ben Bernanke's famous savings glut, part of the reason we've had very low interest rates is that we've had much less capital investment as a whole. Now, a big proportion of that, in fact, all of that, needs to come back in order for us to hit our objectives.
The increased investment that the world needs to be effectively green investment, or investment in this transition
in the transition to
achieving.
it. Yeah.
Got it. If we back up for a second to the macro, and now start to look at what you were discussing from the perspective of the mining industry, maybe if we can separate, well, it's probably difficult to do, but if we look just at, okay, what this means where we have an environment where rates are going up, inflation's a problem. Maybe if we just focus on that for a moment, then we can get into what all the energy transition issues mean for the mining industry. But if we start with the macro there, well, how should the audience in this room be thinking about these enormous changes in the macro environment?
I think, you know, the core thing is that the increased inflationary pressures, the adjustment of monetary policy, the likely, in my judgment, adjustment in longer-term interest rates, so the increase in longer-term interest rates, are all in the context of a global economy that's growing. And it's growing quite solidly. And let me, you know, justify that a bit more. It's not just because it's growing today. One of the things that has changed over the course of the last couple of years is that household balance sheets, particularly in the United States, but also UK, Canada, other advanced economies, have improved quite substantially over the course of the pandemic. people didn't spend that much. In many cases, they were supported, and particularly households who traditionally have been credit constrained, living, from paycheck to paycheck, they have substantial excess savings at the moment. So there's some momentum there that was not there for virtually the whole time I was a G7 governor, because people had a lot of debt, particularly after the financial crisis. Corporate balance sheets are in very good shape as well. And in the environment, there are exceptions, there are pockets of exceptions, but in general, that is the case. So the conditions for that investment, the conditions for sustained consumption are there. So for people in the audience and thinking about investment, I think, macro speaking, there's momentum in the economy. There's multiple engines. Europe is going to do better, which is not something I was able to say for virtually the whole time I was a governor. Europe's going to do better. So we have multiple engines, and we should have supportive financial conditions even with interest rates going up. And then there's, pardon me, Ryan, there's these longer secular forces that are demanding a lot more investment in this industry.
And the investments that need to go into the energy transition.
Yeah.
And what do they mean for people in the mining industry?
Well, I mean, there's a series of metals and minerals that have cross-cutting application in the energy transition. So, copper, nickel, as two obvious examples, molybdenum, chromium.
Nickel just hit a 10-year high yesterday.
Exactly, but virtually every, whether it's wind, solar, what needs to be done for grid optimization, battery storage, all of those need substantial increases in the supply of those minerals. And there's some minerals that have more specific applications, lithium, for example, cobalt, more specific into batteries. This room would know that well. But it's significant additional capacity is required, and sustained demand. I mean, the visibility of that demand. I think we're going to make all the efforts we can to get to 1.5 degrees, but even if all that investment doesn't come forward, we're talking about, a 60% plus increase in demand over the course of the next 25 years for copper, for example, which is an enormous amount, and higher levels of increase in demand for other metals and minerals. And so what had been a niche demand for metals and minerals, which was renewable power, is going to be really the driving force.
You got Goldman Sachs talking about the beginning of a super cycle for commodities that could last 10 years. What do you make of that? Do you agree?
I mean, broad brush, I agree. I think one of the elements of their thesis, if I remember, I shouldn't try and speak for them, but one thing to be concerned about is can we make sure that the companies can get the capital they need in a timely way. And I think part of that, and when I look at the opportunities in the Arabian Shield and where the kingdom is going particularly, is that it is relevant. The carbon footprint of the miner themselves is relevant, or will be increasingly relevant to the whole process. Now, just to be clear, if you wrap together the copper and the nickel and the cobalt and other factors that go into a renewable grid, and you compare it to an existing grid, it's only about 6% the emissions of the existing grid. So, but still, if the world does what it says it's going to do, we're going to end up with, multiple gigatons of additional emissions unless the mining industry gets its footprint down. Now, when I look at the situation here, I think, well, here we have a country that's moving towards 50% renewable power by 2030 alone, has huge additional opportunities, including in investments in hydrogen, carbon capture, and others that they're making to expand that. Obviously, has the potential. Again, this room would understand far better than I in terms of the geology here and the potential there. Also has a great logistical position and is investing heavily in logistics. So from a commercial perspective, we have the world moving to net zero, or looking to move to net zero, huge demand that comes from that. It's important that the miners themselves, as much as possible, have a low footprint. Starting up a new industry at a time where all these other changes are coming in play in the kingdom, it's a pretty good combination, a pretty exciting combination, and I would argue also a necessary development for us, as the world. And last time I was, as I say, last time I was in this amazing place, it was, talking about the global economy and where the global economy is going. So I look at it also from that perspective as something that's truly important.
Fascinating stuff. Thank you so much, Mark. Please join